Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
All good in the hood, Joe. As we were just talking about, I have a big old Woodinville listing coming up here, just an awesome house, and had a last minute thing I had to help with on my client, and I am driving a U-Haul to the dump today, which is not normal. But
how big is it?
Oh, it's like a box truck. Using it as a school lesson for my kids. Like I said, we're all going to the dump. We're going to have a dump experience today. So, we do whatever it takes here when people need help. But it's kind of fun and funny at the same time, kind of like a summer day. They're all bored anyway. So I thought, why the heck not? Right?
Yeah.
Let me get them out the door. Why the heck not? What are you up to? It's been a while. We took a little summer break here. We took a little summer break here, guys. So we're back at it here after taking about a month off. And a little side note, if you noticed, you might not have, we haven't posted any new podcasts lately, but check your email, everybody. If you are not on our email list, what should they do, Joe, if they're not on our email list?
They should head over to seattleinvestorsclub.com and they should just sign up on any of the pop-ups or forms that are on that website, and they will become enlightened by our email list.
There you go. And why? You're probably like, shit, I don't want to sign up for stuff. But why you should do that is because we have been sending out some really awesome podcast series. We've got, 125 or so podcasts out on the nuts and bolts of real estate investing. And over the summer here, where we all take a break, which is nice. We've been doing this long enough. We've been able to send out some emails with basically a educational series of some of our best content on certain topics like lending. And I think last week was wholesaling, but the week before we did a lending one. And now, as of today, we're going to circle back up on the lending. But before we do that, tell us, Joe, what have you been up to for the last month?
Well, I've got good news for everybody. I'm back on the road, so now I'm interesting again. We basically took off back into van life, and we've been through Bend, Oregon, which is freaking awesome. If anybody's ever spent time in Bend, they know that. And we're headed slowly down to the Grand Canyon, which we are going to do a 2-week rafting trip down the whole canyon. So
wow, what a guide.
Yeah, with I think there's like 16 other people. So they've been doing these trips and telling people to quarantine or get tested before coming. And there's a full guide. It's like a all-inclusive Grand Canyon trip. So they like have food and shelter and everything for you. And like we signed up for the most physical one you could do, which are you paddle, but then otherwise they take care of everything for you.
Ooh, so you're going to be paddling down the river on the rapids. Now I'm going to go into my worry mama mode while I think about that every night for the next 2 weeks or 3 weeks. But so what the COVID thing though, they're going to test you guys all, or how does that work?
No, I think that they have some sort of legal thing or some reason business-wise, something that they don't want to actually force people to do that. But they have all of these measures in place of like how they're going to get people out or isolate you on the river if you do get sick, which is pretty strange to me. I'd rather just have them force us to go get a test 3 days before or something and then like bubble up in the hotel. But there's some reason that they're not doing that. I'm not sure, but we'll see.
Your mask making me nervous thinking about it.
Well, the interesting thing is they've also said to us that you cannot separate yourself while rafting. So they're like, you're going to basically be, choking on each other's spit while you're in the raft, but we're going to try and do social distancing when we're not in the raft. So I don't know. I think we've kind of talked about it. I think that it's silly. It's like, just put up some measures beforehand, do your best, and then know that you're not going to be able to social distance when you're going down the river. So.
Okay, guys, you can all worry along with me now for the next 3 weeks to month while we watch Joe have some fun and then worry that it's going to be okay. So We're going to shift topics now that I'm concerned. And we're going to bring in somebody who brings me peace and calm instead, Joe. And that is my friend and my favorite go-to lender, Mr. Keith Pitsch of Loan Depot.
What's up?
Keith, you're going to keep us all in check and keep us. Not only are we not going to be worrying, we're actually, when we're done with you today, Keith, we're going to be worrying about why we haven't like refinanced or something because rates are so low. That's what we're going to be worrying about instead of Joe's crazy life adventures.
So yeah, we bought a new trailer and we're actually going to join Joe down in the Grand
yeah.
Yes.
Well, okay.
I kid. But we are going to Glacier. I'm excited to go to Glacier National Park. So,
are you guys RVing it?
Yeah. Well, we've got a travel trailer.
Nice.
I haven't bridged the gap into the world of RVing yet because I like to, when I get to my destination, still have a vehicle. And I don't know if I want to tow behind a truck or a get-around car. So
that's a valid point.
That's how I grew up.
Well, us Clark girls are headed to Twin Falls, Idaho, and wherever we can find on the way in the next few weeks here. So, looks like we'll all be on the road. So, good stuff. Well, guys, hey, everybody listening, thanks for listening today. And what we're doing today is, if you haven't noticed, interest rates are insanely crazy. I mean, we always used to say, like, interest rates are historically low. I don't even want to use the word. I don't know what's the right word to use. Crazy ass low. I mean, what do you say?
Crazy ass low. Yeah.
Crazy ass low, right? Yeah. So we thought it'd be a good idea to check in with, like we said, my favorite go-to lender here, Keith Pitsch of Loan Depot. And we're going to discuss some, I'll call it strategic financing strategies, or we're just going to talk about it because it sure feels like we should be doing something. No matter if you're talking about your primary residence or investment properties or whatever, buy and hold, if you're a landlord with these rates so low. So let's jump into it, Keith. How's it going?
Awesome. It's going great. It is super crazy times given the fact that both the 15 and the 30-year fixed, if you have a solid credit score and a not even a huge down payment, a 5% down payment, you're somewhere in the twos. So it's been very, very busy for us in the mortgage world. I don't think that you've seen a lot of postings of all your mortgage peeps on Facebook because we just don't have time right now. We talked about it before we jumped on the call here and pushed the record button. But if you haven't at least explored the opportunity of what today's market has to offer to you in the terms of rate and term refinances, pulling cash out, you owe it to yourself to at least have a conversation.
Right. Totally.
Conversations are free. We haven't started charging for those yet.
Right. That's what we call it, like Dr. Keith, right? It's you go to the doctor. Well, you guys should all consider your conventional lender kind of like your doctor, your home financial, your not home even, just any of your real estate doctor. And you need to check in at least once a year with that, if not more.
And there's no copays.
Now. What's that?
There's no copays. You can just
no copays.
Yeah.
Except for, actually, maybe you can even get rid of your copay, which other words might be called your PMI.
Yeah, absolutely. There's a lot of PMI talk about eliminating them. One thing that came up as far as one of those check-in items is I was talking to a client earlier this week, yesterday, because today's Tuesday. I talked to him yesterday, and he was surprised at the huge difference in mortgage insurance just by doing a refinance from 95% loan to value down to 85% loan to value. It was really interesting and eye-opening to him. Though he couldn't get rid of mortgage insurance completely, it really changed the dynamic of his mortgage insurance effective rate.
Interesting. Because normally to get rid of it, you need to have in order to eliminate it, you're going to need to have 20%, right?
Yeah, 20% equity in your house, so 80% loan to value, not to exceed. And that gets rid of the mortgage insurance requirement at a new loan application. if you have a mortgage that you're continuing to pay on, you have to get it down to 78% loan to value of the original loan balance, unless you go to the servicer and ask them to review your value. But that's servicer to servicer specific. Not all servicers do that.
Do you have to have your loan for a certain? Let's say you're attempting to get rid of your PMI.
Yeah.
Do you have to? And we know that we just discussed your loan to value needs to be at a certain level, right?
Yeah.
I mean, the market's hot, so I mean, boy, values are probably up again. If you bought, is there a time limit that you had to have had? You had to have had your loan for a certain amount of years, like, let's say you didn't rehab or anything and you're just trying to get rid of your PMI, nothing like that?
No, if you took out a loan and then all of a sudden you paid down the principal balance to the 78% benchmark, the mortgage insurance has to come off by federal mandate. So it falls off. The only time that the mortgage insurance doesn't come off is when you're over 90% loan to value on an FHA loan. If you're over 90% loan to value on FHA, it never comes off. It's there for the life of the loan. So you're stuck with it.
If you, when you originally put your loan on.
Yeah, correct.
Right. So if you're not FHA and you, for whatever reason, the value of your equity has increased over the last, 2 years or something.
Yeah.
Yeah. Well, you're not necessarily, you are having that or you're not having that with a non-FHA.
Well, with a non-FHA, if your value's increased, your loan servicer, if you have an existing mortgage, your loan servicer has zero requirement to go in and say, hey, your house has appreciated X amount of dollars. You have to physically make that request, right? And then it is up to the servicer to say yes or no on whether or not they're going to allow you to reevaluate the value of your house. So I'm really careful with that one and saying a blanket statement that, oh yeah, hey, if we continue to appreciate at 5% every year, in 3 years, you can call up your servicer and just ask them to reevaluate the value of your property and drop the mortgage insurance. Because it's servicer specific. They could have a particular mortgage servicer could have in a policy and procedure that says we don't reevaluate. We're going to do it based off the original loan amount and the original value at the time of mortgage application.
Would that be a question that people should be asking, or do they have no control over that later? Like when they're going to put a loan on in the initial, in the beginning, would that be a question when you're interviewing your lenders that somebody would want to ask, like, you know what I mean? Like, what's your policy on PMI? Yeah,
you could ask what your current policy is, but if any loan officer out there tells you their policy is X, and they can't guarantee it. I mean, right now, the banking world is changing so fast. Policies are changing. What underwriting appetites they have change. What servicing appetites they have change. So we as mortgage professionals, we have to be really, really careful. And if you are getting a mortgage professional telling you, oh yeah, you can always do it, they're blowing smoke up your skirt. It's just, they can't guarantee it. And I'm very careful on what I say because you know what? I don't want to set somebody up for failure because the market could change. And then servicers are like, no, we're going into a declining market. We're not reevaluating anybody's value.
Right.
So you can ask what their current policy is on reevaluations, servicing, that kind of stuff. But there's really no guarantee because it's life, right? There's no guarantees in life.
No guarantees in life.
Bam.
Like we were just talking about Joe's friend who just went over the handlebars and wiped out and broke 7 ribs, man. That's just one day of life right there. Dang. Right? That's some crazy stuff, guys.
That's a tough day of life.
Tough one. Hopefully he got his refinancing before that happened. He got his refinancing done. So let's talk about why reasons right now, why people, aside from the PMI rabbit hole we just jumped down, why people should check in with Dr. Keith or, their conventional lenders and so forth. That could be lower rates, getting rid of PMI, reducing, your payment, reducing your loan term, Cash out refis at a low rate. Let's go down the list. Give us all the reasons to make us feel anxious about why we haven't called you yet.
I mean, you're hitting all the nails on the heads here. We talked about mortgage insurance, either lowering your loan to value or getting rid of it altogether through refinance is an awesome opportunity. Because a lot of folks that are coming to me have rates in the high 3s, low 4s. So not only are we getting rid of the mortgage insurance, we're also putting them in the 2s with regard to a double dip as far as payment savings. It's awesome.
What is the double? And that just depends on obviously loan amounts, right? I mean,
depends on loan amounts and the appraised value, right? So whatever the appraised value comes back at, that's what we're going to dictate the new loan to value for the new loan.
Right. And are you seeing, like, are your current clients, as far as the length of time, I mean, they haven't had their 4% rates that awful long.
No, I'm glad you said that, because believe it or not, at the end of 2018, right, which is just a year and a half ago, November in 2018, almost 2 years ago, we were almost to 5% on a 30-year fixed. I'm going to let that sink in for a second. Less than 2 years ago, we were double the interest rate. It's crazy.
And the market is so hot. The values are holding very high right now.
Yes, they are.
Mean, you combine that stuff, and like we said, I mean, it's just crazy not to check in, right?
Yep. So PMI is definitely one. The other thing that we like to talk about right now is, with rates being so low, grabbing a 15-year fixed or a 20-year fixed is exponentially a great way to lower the cost of your mortgage, right? I was advising a client a week ago, and they're right at a $400,000 refinance. And we were looking at refinancing on a 30-year fix at 2 3/4, so 2.75. And just to make sure we're crossing all the T's and dotting the I's, the APR was 2.787. But I illustrated the life of the loan. She was going to pay $191,000 worth of interest on that mortgage for that $400,000. And I said, hey, if you take a 15-year fixed at 2.5 on a $400,000 loan, APR again 2.6, you're only going to pay $81,000 worth of interest over the life of that loan.
Well, yeah.
Half of the interest. And her big goal was to make sure that the mortgage was paid down or in a respectable place when her 2 sons went to college. I'm like, this is how you do it. So it's pretty substantial. If you're going to be in your house for a long time, it's now time to really look at long-term financing, as opposed to, hey, let's just get in, and yeah, the rates are high in the 4s or touching 5s. Let's just get in and double dip on appreciation and paying down the principal balance. If you want to chunk down fast, 15 and 20-year mortgages are awesome opportunities right now, because the cost of funds is just so cheap.
I think most people are probably under the impression, if they were to do that their payment would go up. But I think what we're trying to say is, you called me because you're like, I need to do something. Rates are low. I better check in. Right. Yep. And are we kind of saying, like, hey, look, it's not like you're calling because you can't afford your current payment. You're calling because you're like, oh my God, rates are so low. I better check in and see what's up. You didn't even realize that you thought you were calling Keith for a lower payment. But what you might end up with is not lowering your payment, but saving $100,000 of interest in your loan term, reducing. Are we sort of saying something like that?
Yeah, that's exactly what we're saying.
Well, restate what I just said then.
Yeah, so going from a 30-year fixed to a 15-year fixed, as you indicated, yeah, you're going to see an increase in your mortgage payment, but it's not a substantial increase, right? Depending on where your rate is. Obviously, if you're in the low 3s on a 30-year fix, going to a 15-year fix will be a lot more substantial. That payment shock will be a lot more substantial than if you were like 4 1/4 or 4 1/2. So that's a really interesting number that I'll see what the break even point on a 2.5 15-year fixed is into a 30-year fix. I'll punch that number in, but not right now. But there's lots of opportunities. Also, this one of the fundamental differences between this little economic situation that we find ourselves in with COVID-19 and the mortgage meltdown of 2007 is everybody has so much equity in their house right now. And as you said, the market is just crushing it. So I don't think from a regionality standpoint that we're going to see any depreciation. We might see maybe more of a leveling off, but I don't see any negative impact on the forefront, because I've talked to a lot of people that are looking to buy right now. And they're like, oh yeah, it's going to come. It's going to come. I'm still seeing multiple offers on all the first-time home buyers and all the move-up buyers that I'm working with. Everybody under $1 million is in a fist fight in multiple offer situations.
Well, I shocked myself. I just sold over $1 million with a fist fight and was shocked. Didn't think it would appraise. Totally appraised for like 3,000 more, than I thought. And I didn't underprice it or anything. You know what I mean?
Yeah.
What was I going to say to you? I just had a really good thought and I can't remember what it is. I as we're talking about this, dropping your term down and the huge amount of savings, like you said, your case example of a client who is like saying, I'd like to have my loan paid down to X amount, by the time my kids graduate. That's rings true with even myself here. For those people that have rental properties, for example,
Yep.
that have equity, could they do like a cash out refi on those and then take that and pay down their primary a bit as well as, move to a lower term, right? You're taking like your properties in like an entire review and, maybe, you can handle the loan on the rental property and focus on getting your primary down to this more favorable rate and term?
Yeah. So my strategy that I work with a lot of my investor clients on is exactly that. Keep the leverage on your investment properties and pay down your principal residence. And then what you can do is then turn around and use HELOCs on your principal residence as your working capital, right? So we can then help people get out of the rat race of using hard money as an absolute go-to for flips or short-term acquisitions to bring rental schedules up as far as properties that are hitting the market. That's a really legitimate strategy. And
the thing is, though, I just want to drill down on this. It's not like those who are in the real estate biz or investors and should know, hey, you can do that, right? That's not a new strategy. But the difference, the frosting on the top right now is the fact that rates are so low. People use, it's the term. It's that getting the term down, maybe, right?
It could be term. We always have to do a fine balance, and we have to have a really deep conversation as far as where are you at in your real estate strategy and plan? Because dropping term is going to mean your interest or your monthly payment goes up, which means your cash flow can potentially go down, right? Your expenses go up, your cash flow comes down, right? So we have to make sure that we have a fine balance there and execute on what you're looking to do. Case in point, I had a client that came to me and said, hey, we want to take some equity out of our owner occupied so we can buy a non-owner occupied. And, most loan officers would have been, yeah, great, I'll do that. They wanted a 15-year fix. And so I dove a little deeper with these investor clients. They're starting out. And I said, hey, what is really your long-term goal? Tell me where you want to be in 5 and 10 years. And then all of a sudden they opened up and said, hey, we want 20 doors in the next 5 years. I said, then you don't want a 15-year fixed on your owner-occupied house because that's going to impact your debt-to-income ratio. And they go, we never thought about that before. Right? So
good one.
We need to make sure that we're putting together the mortgage plan that is right for the current position of your real estate investment plan, right? Because if we go out there and throw your primary residence on a 15-year fixed, I just blew up your debt to income ratio. Because guess what? There's no income offsetting your owner occupied residence, just your income. So, so lots of moving pieces there. The other thing too that we have to be cognizant about is, people do have a lot of equity in their houses, both investment properties and owner occupied properties. Right now with the current underwriting guidelines, there's still a little bit of worry in the mortgage world. So investor guidelines are starting to get a little tighter with regard to reserves. So how much money do you have in the bank? So we got to be careful that we're acquiring so that we face a month TI requirement, right? So we have to make sure that we have proper financial reserves in place, because I definitely believe that requirement for the investor will continue to get more and more stringent as these moratoriums on eviction, as these different things for investors kind of complicate our world, right? The underwriters are going to want to make sure that you're financially solvent to carry an investment property should your tenants decide to cash in on, hey, I can't get evicted right now, I'm just going to stop paying my landlord.
What is the reserves requirement these days, or about? I know maybe it's different for every lender, but about.
Yeah, general rule of thumb is, and if it's not universal by now, it's going to be universal here very soon, in my opinion, that you better have 6 months of principal, interest, taxes, and insurance per property that you have on your real estate portfolio. If you don't, there's a likelihood that you will not meet the reserve requirements and not get that loan.
So now that we're going down the path of tougher gloom and doom a little bit, let's might as well hit on the pitfalls like we were talking about earlier.
Yeah.
If you're self-employed and investors, and what's the status of all that?
So let's start with the investors. The investors.
Well, maybe we should start by saying don't quit your day job.
Don't quit your day job. Don't quit your day job at all. Investors out there that have real estate portfolios that were playing the game for BRRRR or long-term hold and cash flow. The one thing that you have to be really cognizant about right now is part of the underwriting process to use rental income to offset the mortgage payment. You, the landlord, have to show that you've received rent from your tenants in the prior 2 months.
Right.
So
if they're only going to count if you received half, they're going to count that, or they're like, nope, you're going backwards. You're
going backwards, and you'd have to qualify with the full mortgage payment on your own income.
So it's not that they're going to qualify on how much you've collected. It's if you've gone backwards because you're having to give some rent breaks right now, then you're out.
Right. So if you got a duplex that one of the tenants decided not to pay you, we're going to look at that whole duplex as not stable and not likely to continue to pay you. Therefore, we're going to hit you for the full payment of that mortgage in your debt to income ratio.
Yuck.
Yeah. So those investors that do have real estate portfolios, it's something that you have to keep in mind through the mortgage process. You have to see that you have that rent coming in. Otherwise, we're in trouble.
So basically, if you're an investor looking for deals right now, you should be researching C properties who have loans maturing.
Yeah, you could do that.
You
could totally do that because they're going to have a hard time qualifying.
Right.
Because that is definitely through the weekly calls that we've been having, and through all the other statistics that I've seen, the C-class investment properties are the ones that are hardest hit right now.
Right. C-class, guys, means, like no amenities, no rehab, maybe.
Yeah.
Those are the ones you want to buy anyways. right?
Yeah,
But
exactly. Because they have the highest upside.
with that said, though, those are likely the properties that you won't be able to get seller financing on because they're having their loan mature, right? So for
Right,
those
and the
of you that
thank you.
are investors that are broke and thinking you're going to work your way through with creative seller financing, however, with that said, not that I'm thinking too hard about it, but there's probably some sort of lease situation there, or something like that. Like some sort of crazy master lease thing that could happen.
Yeah.
Very advanced thinking there, so we won't go there today. But yeah.
Yeah, so it does apply a little pressure. So if you are managing a real estate portfolio and want to take advantage of rates, and you have tenants that are paying you on time right now, get it done now.
Get it done.
With the executive order and the lame duck sessions from Congress and the Senate right now, which are just political BS. I'm not going to go down that rabbit hole.
Where are we? Do you know? Because now we don't know. We're not lawyers. We don't know exactly everything that's going on. But what is the new update? Are they down now? They've changed it so $600 unemployment is to $400 a week extra.
Yes, only by executive order. Since the Senate and the House couldn't pass a bill to extend the CARES Act, only through executive order, Donald Trump and the administration said, hey, it's going to be $400 a month until something gets passed through the Senate and the Congress. And really, the Senate and the Congress need to pull their head out of their ass and do something, in my opinion.
Is there a time limit on it? Is it through the end of whatever, or?
I don't know what the time limit on that is, but it's an extra $400 on top of the Social Security. So I haven't read the full executive order. I just saw that it was done over the weekend. So,
right.
Yeah, we just need our Congress women and our senators to step up and make something. So we'll see how that works out. So that is that. As far as
let me ask you something, Keith, on top of that, little extension of that conversation. So 6 months reserves per property on your rental properties.
Yep.
And what if you have, let's say, 3 or 4 properties and you're hitting them on 3, but you're partially hitting it on the 4th? What does that mean? That wipes you out?
You're partial, like the reserves are only partial on the 4th?
Yeah.
Yeah, you got to have enough for each one of them. And if you don't, then you don't qualify. It's a light switch. It's an on or off moment. It's not a maybe moment.
Yeah.
Yeah. So you definitely want to reserve well. The nice thing about reserves is they can come in the form of retirement funds to the tune of 60% of your vested retirements.
Okay.
So that's one way to kind of cheese it out. But as a person who has lived through the real estate mortgage meltdown of 2007, guys, here's a real moment. If you don't have 6 months per property, you're on thin ice, because you're just one crappy ass event away from jeopardizing your whole situation.
I mean, that might be a time, honestly, to think about, like, let's say you've got that on 3 properties and your 4th doesn't. Might be, or time to sell one. And beef your reserve.
Yeah, beef up the reserves and then go find a performing asset. Or
that's you guys. That's you.
Right now, I mean, the multifamily market's hotter than the single family residence market, if you can believe that. So, I mean,
well, yeah, and people still need exchanges, and those are always great exchange properties too, right?
Yeah. So make sure that you're properly leveraged, because especially in the C class and maybe some of the low end B stuff, I think this next year is going to be a rough market for y'all.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show.
Let's flip the coin over to the self-employed individuals, because y'all are under the microscope right now when it comes to underwriting guidelines. Self-employed individuals, we always take the 2-year look back. You're self-employed. We would look at your 2019 taxes and your 2018 taxes, and then we divide by 24 and underwrite you that way, right? And that would be your qualified income. Right now, we're looking for business bank statements, and we're looking for a year-to-date profit and loss to see that you're in some way, shape, or form earning income, right? And if your income from 2019 to year-to-date has dropped more than 30%, there's a high likelihood that you're going to be straight up declined.
Okay.
One of our requirements as a result of the Dodd-Frank Act after the mortgage meltdown was that we could document and provide verification that the income has been collected over 2-year history, as well as it is likely to continue and to be stable, right? So we missed that last precedent, likely to continue and to be stable going forward. Because of COVID-19 and everybody's disruption there for that better part of 3.5 months, there's a lot of self-employed individuals that find themselves not able to keep pace with revenues of 2018.
You know, I'm going to insert something here because I'm thinking about it while we're talking.
Yeah.
If you are a broker investor, okay,
Mm-hmm.
and you flip properties and you're self-employed essentially, right?
Yep, correct.
Now, most of you guys you're going to list your own properties, let's say, okay? And you would list at a zero. You'd list it yourself. You'd pay your buyer's commission. I'm just talking out loud, making this shit up as I go. Mm-hmm. Would it be helpful at this point, if that was you, to actually pay yourself a commission so you can bank some income? Oh, and so you have to let your broker take a bite of it. If you are trending down in your income, right? Yeah. I guess that doesn't matter because it's either flip income or commission income. Maybe it doesn't matter. Net doesn't matter.
On that, it's going to wash out. So not necessarily.
Not necessary. Yeah. I'm just thinking out loud as I go here. I'm trying to think though if that makes any type of sense in anywhere. But go ahead, keep going. So
yeah, so where I see this hitting the hardest is our folks in the service industries. The restaurant owners. My dad owns a body shop down in Portland, Oregon. If you guys need your car repaired, go to Speed's Auto Body. Just a plug for my dad.
Just don't drive through downtown Portland.
Yeah, just don't. Yeah, well, he's on the other side of the river, so that's good for him. But Portland's just still a crazy show. So to that extent, there's a lot that in 1 year's time that they were crashing in 2019, 2018, and then in the last 2 quarters found themselves not able to qualify for a mortgage. It's a little tough right now. So I just want to say, if you're self-employed and you're looking to make moves, it's super imperative right now that you talk to a mortgage professional and figure out exactly where you are and what you qualify for.
So in a nutshell, like you said, the old way of qualifying you is out the window, and the current way of qualifying you is looking tell me if I'm wrong, is looking 2019 to current. Mm-hmm. And making sure that you are, so you said if your income's down 30%, you might get your switch turned off.
Completely.
But if you're 20% down, you're just going to be, you're still in the game. You're just adjusting your numbers.
Yeah, we're going to adjust our numbers down to your year to date.
And we'll count right.
Yeah.
Down
so
to
if your year to date is still substantial enough to support whatever mortgage you want to go out and apply for, you could still roll that way.
So literally, though, people need to be cognizant and aware of timing. You have a big closing coming up. You know how many months in you are from, you know what I mean?
Yeah.
You need to look at your last 12 months, and you better be paying attention to flip the switch on for a second, timing-wise.
Yeah, correct.
A snapshot.
Yep.
But they're going to check again. Are they going to check again it takes 30 to 40, how long is it going to take? 30 days, they're going to check twice.
Yeah, on a purchase, it's 30 days. On a refinance, it's somewhere between 45 and 60, depending on your complexity of the mortgage.
So if you're doing a refi, then you're going to get checked twice. Once when you start the process, and 60 days later, right before the process ends.
Right before we fund, correct. We have a requirement to check on all incomes, regardless of self-employment or not. All incomes have to be checked on within 10 days of closing the deal. So,
right.
Yeah, we're checking now and we're checking down the road. So it's just something that they have to take into account. If you're a listing broker, you should definitely be asking your selling clients if they are self-employed. And if they are self-employed, have they talked to a financial or a mortgage person to make sure that they can make their next step. And also, as a professional courtesy, if you're going to a listing appointment, you need to ask that person if they've taken forbearance. Because if they've taken forbearance, you have to get back in good graces and be paying that mortgage for 3 months before you can qualify for a new mortgage.
Right.
And paying off a mortgage in forbearance does not absolve you of that requirement. So you could find yourself.
So you're saying if you took forbearance, what does that last part mean that you just said?
So if you took forbearance, like you could start taking forbearance. You could still take forbearance if you wanted to, right? Because we're still considered in a national state of emergency. You could take forbearance right now and then turn around and list your house, right? So if you listed your house while you're in forbearance, then you'd have to close the house. And I wanted to go buy a new house. I'd have to close the house and then wait 3 months.
Okay.
I couldn't turn around and get right back onto the mortgage horse because I didn't establish a 3-month pay history on my trade line. I just paid it off out of forbearance.
Right. So, I mean, in that case, nobody's establishing a 3-month pay line because they're not paying on, they're not paying on anything. They're probably renting or they're living with somebody, right? So you're saying that you get a clean slate if you took forbearance and you sold your house while you're in forbearance,
mm-hmm.
then and you wanted to go buy something else.
Yep.
After you wait 3 months, you get a clean slate?
You'd have to wait at least 3 months, and then it's up to the underwriter whether or not they want to write your loan. Because we have the option to wait up to 12 months from that forbearance payoff.
Oh.
Yeah. So
there'll be some shark lender out there that'll, or some risky lender that'll probably do it, right?
Yeah, of course.
Right.
Yeah. Of course there is.
Right.
But again, you're going to pay through rate, right?
Right.
So for those self-employed folks and those individuals that have real estate portfolios, there are bank statement loans and there are debt service coverage ratio loans that you can still utilize that aren't relying on your banks or on your actual profit and loss, or aren't relying on you to service that, especially in the debt service coverage ratio approach. We're just looking at the property. So there are a few ways around that.
Are those non-QM type things?
Yep, that's exactly it. The non-qualified mortgages.
So we just took you down, people who are self-employed. Now let's bring you back up and touch on that for a second. So if you're like, shit, that's me, my income down 30%, but I'm sitting on a bunch of cash, right? Because I sold a bunch of properties or flips and haven't been buying anything, and I got a stash of cash now. And I've got some retirement stock stuff that I'm 60%. I can count 60% towards that.
Yep.
I can't help myself right here by saying, guys, that if any of you are interested in eXp Realty, I don't know if you guys have seen what happened, but we're at around 8 or 9, and it's up to like 29.
Your stock?
Yes.
Holy crap.
Speaking of vesting, thank you very much. So anybody wants to learn more about that, then hit me up on a side note, because
wow, you guys tripled?
It's crazy. I don't know. Yeah.
Did you guys go into making chemicals for COVID vaccines or what?
I don't want to talk about it anymore because it's public record. So I don't know that I am supposed to talk about that. So I'm not going to.
Wow, you guys tripled. That's awesome. No, well, that's great. I mean, you're just stating facts there. You're not
right. Stating facts. Holy shit. Speaking of, if you're a real estate, investor broker trying to build your vested retirement account, you might want to call me. Okay, 206-910-2985. Couldn't help myself. You reminded me, speaking of this vested stock stuff, when we're talking about all these self-employed people and how we're going to talk about what your options are with the non-qualified or whatever we're calling those loans that you're about to tell us about.
Non-qualified mortgages. So there's still great options, especially for my restaurants. What they can do is they can do a 24-month bank loan. So their last 24 months worth of bank statements. So back in their heyday before March of 2020, they still had good rolling account balances going on. So deposits that they had prior to lockdown, so long as they're ticking back up now. So we'll look at the full history divided by 4, right? Take all your deposits, pull up by 24 months, and then we'll look at the last 6 months since the COVID and see that you're track upward. As long as that's thing, we can do a bank statement loan.
Well, let's break that down though for a minute, because we just said that your income, if it's dropped on the old way of if you're self-employed, taking 2018, we're in 2020. So taking 2018 and 19 divided by 24 would be the old way. And now we're looking at, 2019 forward. And if your income's dropped 30%, you're getting light switch turned off on you. And how is that different? How is that?
Yeah. So this is different in the non-QM market. In the conventional and the jumbo market, you're subject to what you just said. In the non-QM market, they're showing, and their documentation of the ability to repay is through the deposits that you have coming into your business. And
don't deposits equal income?
Yep, deposits equal income for a business. So business has to be around for the last 5 years, and we're going to take a 2-year look. Pretty powerful stuff to help those specifically in the service industry that weren't able to do their thing. Well, everybody was locked down. So,
well, I'm a dork, which everybody knows, right? I'm not really that smart. I just surround myself with smart people. If I'm a service industry person and I have my bank statement balances and I've got to show you that I'm having some deposits, right? We don't need to, and you say it needs to be ticking back up.
Yep.
So that means that my income is ticking back up. That's what it means to me. But what you're saying is, how is that different than, if deposits equal income and my income is down, as long as I have deposits ticking back up, I'm going to make it on non-QM versus.
Yes.
So what if my deposits are up, but I'm still 30% down in income?
We don't care. In the non-QM market, it's a completely different mathematical arithmetic.
So the point is, you just have to qualify to get into the non-QM market.
Correct.
Okay, so let's tell us again. Sorry, winding it backwards for you guys. This is me detailed. This is where we get into the nuts and bolts. That's why we're called the nuts and bolts of real estate investing, because we're breaking it down. We're taking this car apart. How do you get into the non-QM world as a self-employed person?
Basically, I would go through an evaluation of your income and assets, as well as your credit score, and figure out what options are available to you. In the case that you don't traditionally qualify for a Fannie, Freddie, or jumbo market loan, we would look to, the first pivot would be to look to the non-QM loan. Is there an alternative way that we can document income? And the bank statement loan is like the best way to do that.
But you have to have been having your business and in business for 5 years. For
5 years. Yep, exactly.
So what if you have a W-2 and a side biz? Let's say you have a W-2 and you flip on the side.
If your W-2 is big enough to manage the debts that you have, then you're game on.
Well, it's not.
Then we're looking at alternative ways to get you qualified, whether that's debt service coverage ratio or it's a bank statement program.
Right.
Yep.
So, and it doesn't matter what kind of business, as long as you're in for 5 years?
Doesn't matter what kind of business, as long as you're in for 5 years. Yep, that's correct.
Got it. Excellent. And what if you are, this is getting technical, and maybe I'm getting too technical and we'll wrap it up soon, but what if you're able to do a non-QM loan, you're in business, you've been in business for the 5 years, you have your bank statement balances and your deposits are ticking up, but for whatever reason, you got a break from your landlord on paying rent or something like that, right? Let's say you pay rent somewhere and, it's not forbearance, but does that matter? I guess that's just an income expense thing. So it's
that wouldn't matter in our world. We're not asking that question. Gotcha. As a business owner, did your landlord let you get out of paying your rent? It's not a question that would come up in the market.
Excellent.
It would definitely be an issue if I was trying to refinance that commercial property and they weren't collecting rent. But with regard to that individual tenant in the service industry not paying their rent, that's not a question that we would ask.
Well, let's talk about one last thing before we wrap up today. Well, two things, actually.
Okay.
First thing would be, if you're thinking about a cash out refi or a HELOC, who'd you rather? What's your take on that?
Cash out refinance or a HELOC. Depends on what you're trying to do with it, right? If there's one bucket of people that are trying to consolidate consumer debt, car payments, credit cards, that kind of stuff, in that position, I would say you should definitely do a first position cash out refinance, lock in that low interest rate, be done with it, right? In the position that you are looking to get working capital to run flips, the construction side of a flip, to just straight up acquire houses and transact houses, I would say do a HELOC, because you're temporarily using that money. One pitfall that I've seen so many people do is they've gone out there and they've done a second position HELOC to consolidate their debt, only to find themselves still with a big revolving line of credit that's only paying interest only, and they don't have the resources to pay it down in a timely fashion. HELOCs by design are typically a 10-year interest-only draw period. So it acts just like a credit card. You can pay it up, you can pay it down, and its only payment requirement is interest that accrues on the outstanding balance on a monthly basis, right? So there's no way to get ahead if you're just the standard homeowner unless you're paying above and beyond that minimum payment due. So the folks that are looking to do debt consolidation, I definitely advise doing first position, cash out, refinance, fully amortized. You're gaining headway every month, right? It's the compound effect at that point. I've been doing a lot of HELOCs on owner-occupieds for investors who want working capital. That's a great way to find working capital. And with the interest rates being so low, it's a much better alternative than getting hard money lending.
Same underwriting standards, though, as
Yes.
far as if you're going to go for a HELOC, right?
Actually harder. HELOCs require higher credit scores than your traditional Fannie, Freddie, and FHA loans. Fannie, Freddie are down to 620. FHA is down to a 580. To get a HELOC, my two resources that I do HELOCs through, they require a 700 credit score. They used to be 680, but with so much volume, they've closed the box a little bit to slow down volume.
If you guys are like, dang it, I'm a little short on that credit score, guess what? We can help you get that back up because we've done some kick-ass podcasts with our friend Joseph Kidworth.
Joseph.
Yeah.
He was just on my Thursday. He was just on my Thursday live. Yeah.
Oh, so awesome. Yeah. We actually should circle back up with him too. And Joe, maybe drop our first podcast that we did with Joseph maybe into the show notes today. So people can grab and listen about that. Well, that's all good. Another thing is, though, let's talk about you and I actually, I think somebody on my team called you recently because I have a sell-buy situation going on with one of my clients who owns their home free and clear.
Yep.
Currently still employed. And we were talking about, well, your option is to either, go get a loan on the new home when you're ready or do a cash out refinance on your existing home and get ready, or a HELOC or something. And we were debating what came up was timing, right?
Yep.
So tell us about the timing between, if you are a broker or you're talking about yourself or friends or family or whatever, and you are trying to figure that out, what's the timing on those types of things right now?
Yeah. So the situation at hand, like Julie said, the guy owns his house free and clear. He wants he's downsizing, correct? Is that what he's doing, Julie?
He's getting the hell out of Seattle. Yeah.
Well, so that is a lifestyle improvement, in my opinion. But
I wouldn't even say he's downsizing. He's like retiring at some point, in the future and just planning ahead. You know what I mean?
So
long term.
So it's always better, and I'll say this from a mortgage perspective, but it's always been my opinion that if you, the seller of a house, could get out of there and let the real estate professionals do their job, stage the house, take some awesome pictures, really allow the house to be open to the market, that is definitely the best way to get out there on the market today. Because there's going to be lots of people that are going to be coming through your house right now, and depending on how COVID sensitive you are or just how hermit you are, you may not want that. So in this gentleman's situation, we were talking about how do we help him go find his new house and then sell his old house. So his two options are to do a 5% down. He could go do a 5% down acquisition of a new primary residence, right? Or he could do cash out with the house that he has right now and then use that cash to be a cash buyer on the other side. The timing situation is closing, right? So closing a purchase right now, we are dedicated 110% to closing purchases on time. I'm closing my purchases probably right around 25 to 27 days from start to finish. So I can close a purchase a lot faster than I can close a refinance. Refinance, folks, we've locked in your interest rate. You're going to wait there for 45 to 60 days because there's no contract, right? There's no seller on the other side of this trying to make their real estate move. And so we always, the mortgage industry in general will always cater to the purchase side of the transaction because there's two families involved, and there's a lot of legalities. So the other consideration that I had when I was advising you guys was, well, if he takes cash out, and let's say he takes $400,000 cash out, and he finds his dream home that was $425. Now the dude's short to close. So we're come up with that extra money, or maybe he finds a $450, right? So then there's no way to go quickly tap that equity again to do it. So at the end of that conversation, my advice is if he's got the equity, or if he's got the liquid money to put 5% down on this new house, he should just exit the old house. His debt to income ratio will have to include the taxes, insurance of the old house, and the new mortgage payment of the new house. Once that's the case, game.
Right.
So that's what I told your associate. If that was what was transmitted back to you, but he definitely has options. My fear was that if he takes the cash out, one, it's going to take him 45 to 60 days to get it. So he's not even going to market to buy the new house for another 60 days. So there's a lot that he could be missing out on. And in 60 days, you got to wait 60 days to list the house.
Right. I mean, yeah, we're talking about all that. Another consideration is where you're buying, what's the competition, because being able to, if you have a smart buyer's agent on our side, we know how to win, let's just say. But, having a cash offer,
correct,
also is something to consider depending on where it is that you're buying, where you're moving. So all good stuff. The point is, guys, you don't have to do it alone, because you've got your loan doctor here, Mr. Keith Pitsch, your favorite lender, whoever that is, that you can talk to. The point is that these are easy conversations for guys like Keith, and you should be checking in for yourself. Like, it's time. Everybody needs to check in. We're not here to tell you, that, drum up business and here, go do something for Keith today necessarily. But hopefully you guys know that I like to talk to people that know what they're doing. And it doesn't have to take a lot of your time when you talk to somebody that knows the investor game inside and out, as well as all the conventional and the non-QM. It's like one-stop shopping, especially for you broker investors or you self-employed people or anybody that's, if you're listening to this, I assume you're interested in investing in real estate. So you want to make sure that you're talking to a lender that's also understands all that, down to the deep nuts and bolts. So today is the day we thought, you know what, rates are so low. It sure feels like everybody's thinking, man, I need to do something. So hopefully the goal of today was to put into perspective for you what you can do or what you should think about doing, whether you're employed or self-employed or whatever.
Hey, Julie, I want to make one last comment really quick, just on state of appraisals.
Yeah.
If you're getting outside of the major metropolitan areas, they are taking forever. Okay. So I just want everybody to realize, if you're buying a second home, if you're looking to relocate to Quincy, Washington, or you want to go kick it in Forks, those appraisals are taking 3 to 4 weeks right now.
Wow.
Yeah. So just the further you get away from the major city, the longer your turn times are.
Right.
So I just want to throw that out there, because it's definitely something in the atmosphere and the current environment that we find ourselves in, because there's a lot of business going on.
And what about drive-by versus in-person appraisals? Is there rules of thumb on that, or is it lender by lender? I mean, I've had ones where I want them. I know everyone was like, I got a drive-by, but there are certain situations where I'm like, no, they need to come in because there's something. We went, this sold over list substantially. They need to see why.
Yeah, and that's a really, really good point. Lenders right now, from a liability standpoint, Freddie, Fannie, and a lot of the jumbo market have opened up the box for the appraiser to do drive-bys, right? So before COVID set in, the appraiser was walking through the house, measuring the room, seeing the quality and condition of the house with their own eyeballs, right? As a result of COVID-19, they opened up the underwriting box to just say, hey, appraisers are now able to go do drive-bys. So if you, the lender, would just do a drive-by, you could do that. And lenders, since we're commissioning them to go out there, we liability in getting an appraiser sick with COVID-19. So lenders, a lot of them have defaulted to drive-by appraisals. So if you're a listing agent or you're a buyer's agent and you've escalated a lot, you need to request of the lender that they do a full inspection on the appraisal. We can still.
What if it's vacant? What if it's vacant?
Even if it's vacant, lenders are still doing drive-bys, right? Lenders have gone into a default action for the most part that we're doing drive-by appraisals. So if you need a full appraisal, you need to make sure that you're communicating that with your lender, and vice versa.
And you also need to be working with a broker that knows how to solve in the event of a low appraisal problem that could happen.
Yep.
That is very important. It's very doable. And you guys need to be making sure you're working with somebody that does that and understands how to solve and block those types of issues before you're even fully under contract. So
count both sides of those coins.
Right?
Yep. Protecting you as the seller and protecting you as the buyer.
That's right. So
super important.
Sure. Call me if you need help, of course, on that. Or if you're a broker and you want to know how I do it, feel free to call me and I will share with you that. You should probably already know, but if you don't and you're newer or you haven't been in the game, you haven't experienced that, happy to talk shop with you guys on that.
Yeah, we all start
somewhere. Many deals that way, I'll tell you what. So
it's a big concern now too, because one thing that we're seeing that we've been talking a lot about is with the lack of inventory, there's not as many units being transacted, right? So typically in markets like this, I look back at 2016 and we were selling a lot more units, right? But the price appreciation was similar, if not more, back then. The appraisers had more comps to pull from back then. Now they only have 2 or 3 comps to substantiate this increase in value. So I think as we continue to have lack of inventory and escalations, we're going to find a period, I think this October and into the winter, that we're going to see appraisals maybe not hold up as well as they are right now. So
I sense, I don't know why, I feel like people are like, oh, I better sell. If I was thinking of selling, now I see that things are selling at high top dollars right now. I better get it sold before winter because we don't know what's going to happen come winter, or more so come unemployment running out or PPP, this and that, and business is actually starting to close because they're not propped up anymore.
That's the wild card. That's the wild card that no one can put their finger on really well. The great thing about it is, as a region, we've been underbuilding, so we don't have what we should have as far as inventory is concerned. So if there's a saving grace of the last decade, it's just we haven't been building enough housing units.
Well, so, even if more listings, we're down. As far as I know, last time I checked here, we're down 30 to 40%, at least in King County, on the listing volumes, right, year over year.
Yeah, and let's be really careful with that number, Julie. It's the number of units sold is down 30 to 40%, not the prices. So many people have misconstrued that topic because they see in the Seattle Times, housing off 30%. That's the number of units sold. So instead of selling 10,000 units, we've only sold 7,000 units, right? So I want to make sure people realize this has nothing to do with price. It has to do with the number of houses that have been transacted.
I'm actually looking at like a July report right here for King County. And, again, it's area by area too, right? Yep. So you got to kind of pull the reports and read. So we don't want to make any blanket statements, I'm trying to look at King right here, just like, King County, it's saying that the closed sales volume year over year for July 2019 to July 20 is on par with closings, 1.71%. Pending sales are, I'm just looking at King County only, are year over year up 14%, but the number of listings is down, we'll call it 6%. So the listing volume is down. The pending sales year over year is up. Which I think it's hard to look at that right now because we've had all these delays in listing timelines. I wouldn't say that's the best thing to look at. Closed sales, though, July year over year, 1.71% change, up a little bit. So to me, the number that sticks out is the fact is also these just the lower amount of listings. I think listings. I don't know. Let's all talk about it. Join me on a Thursday. Let's talk more about it. 11:30 to 12:30 p.m. I like to look at the number of new listings coming on because it shows intent, right? It shows the intent mindset. You know, we know there's a lot of buyers out there with low rates that want to buy right now, right? We know that the market's on fire, right? The prices are holding great at the moment where we're at in most counties, right? But what is harder to judge is the intent, the mindset of the homeowners. And I believe that the amount and the volume of listings coming on is an indicator of intent. I think I was listening to maybe like Jay Scott or Ken McElroy, somebody like that. I can't remember who else was talking about that, but or maybe it was Mike Del Prete. I think it was Mike Del Prete, or however you say his name. If you guys know who he is, if you don't, look him up on YouTube. He's awesome. I think he's out of New York, but he's a data analyst, you know, for like Inman and all these things. And he's been focused on the Seattle area because we were first hit by COVID. So Mike Del Prete, if you want to know more, hit me up on Messenger and I'll connect you with one of his YouTube videos and you can listen to his channel. Yeah. But other than that, we should probably wrap up. I was trying to tell you we were going to stay on short today, but of course, every time I talk to Keith, that never happens. So
hey, good conversations are hard to close down.
Right. And it seems like we keep talking about lending and, you know, we're like, oh, here, Julie and Keith are at it again. You know why, guys? Because the most important thing you need to stay on top of right now is the lending. I mean, you got to know what's up. You got to keep up to date because that's your medicine, you know, for what you need, either good or bad. You got to know what it is and it's changing. Yeah. And that's why we keep talking over and over.
Unless you're sitting on a couple $1 million and you can completely fund your acquisitions, rehabs, and remodels by yourself, then you need to know what lending is doing.
And it's changing all the time. So thanks, Keith, for joining us again.
My
and
pleasure.
The beautiful part, guys, is that most weeks when he's, you know, we're all getting busy there, but at least for the start, usually every Thursday, Keith is able to check in with us on our weekly meetup and mastermind, which is a great place to stay on top of things. You can pop in for the full hour or you can pop in for 15 or 20 minutes. But I'd say that we have a pretty good batting average with Keith showing up with us. And usually we check in with him maybe for the first 15 minutes if there's something, a new development in lending that we need to know about. That's a good way to plug in on that or to get your personal questions in. You guys have personal questions. You need personal help. You know, part of the reason why we do that is it's just a great format and forum for people to bring any question that they have or share any experience that they've had with the group. And that's every single Thursday. We're back on. We took 2 weeks off for the summer, but we are back on 11:30 to 12:30 every week. First, we're going to have Keith tell us his contact information if anybody needs to talk to Keith now. And then second, Joe is going to tell everybody where they can find the details, not only of today's podcast, but to join us weekly on our weekly check-in. Everybody's invited. Any real estate professional, new, old, in the middle, long hair, short hair, big feet, small feet, you're all welcome to join us every Thursday, 11:30 to 12:30 on Zoom. So Keith, how can everybody find you?
The best way to get a hold of me is just to give me a call or send me a text at 713-713-9063.
And Joe, where do we find today's information and meetup stuff?
Yeah, guys, you can get all of the show notes at SeattleInvestorsClub.com/125. That's SeattleInvestorsClub.com/125. And if you'd like to join us on one of our Thursday meetups, go to meetup.com/Seattle Investors Club and make sure that you have joined us by clicking the link there.
Right. And to get notifications from us and things like that, make sure you've joined our meetup page too, right? Just that you follow our meetup page, however that works, subscribe, whatever. And what else was I going to say to you guys? If you have not, all these things we're talking about, not only do we talk about like current topics with lending, but super also important and valuable is we have all kinds of awesome past podcasts about how to maximize your lendability. Those things still apply, okay? And you're going to want to know that. And in the last 2 weeks, for example, if you are join us on our meetup page or simply just go join us on our Facebook page for Seattle Investors Club and we have your email address, you would have received a podcast series of some of our best podcast topics around lending. So stuff like we talked about today, but also how to maximize your lendable income and a bunch of other kind of specialty topics on lending that you guys are all going to want to know that are evergreen. So basically what I'm telling you is sign up if you want more information. If you missed that and you were one that did not receive that and you would like to get that, just shoot me a message. You can call me at 206-910-2985. Don't call me on that. Just text me and say, Julie, send me the lending podcast series, and we'll do that as long as you drop me your email. Other than that, I'm headed to the dump.
We'll have fun.
Yeah, little life lessons for the Clarkey girls today at the dump. So everybody, Joe, please stay safe. Wear your kayaking helmet and your mask. I know you won't, but please do. Don't tell me if you don't. And Keith, safe travels on the road trip.
Thank you much. Have a great time. Thanks for having me.
Can you tell us one more time, Keith, where your live show is that people can watch every week?
Yeah, Real Estate Now. We do it every week on Facebook Live and YouTube Live at 10 a.m. Thursday mornings.
All right, guys. Excellent stuff. All right, over and out. Thanks for joining us, everybody. We'll catch you next time.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.